Hello, my name is Michael Clements, and I'm the Managing Director of Cynergy Research Services, which provides investment opinions and a model portfolio of 50 companies that we've chosen from the biggest, best, most resilient, profitable, and growing companies around the world. This is the second of a series of informative videos that we will create for investors to explain our thoughts on investing in general and elements of our investment strategy. Hopefully in time, some of you will decide to become clients of our service offering. And with that in mind, you can check out our website at www.cynergyresearch.com. The purpose of the second video is to acquaint you with all the investment choices that are available, their rates of return, and to begin our discussion on risk. At Cynergy Research, we've looked at a wide range of investment opportunities worldwide and zeroed in on large cap global companies as our preferred investment vehicle for a number of reasons as follows. Savings account interest levels are generally far too low and offer zero capital gain potential. GIC interest rates are also generally far too low and offer zero capital gain potential as well. Bonds can offer reasonable rates of interest during peak periods, but suffer capital erosion as interest rates climb. And in addition, over long periods of time, bonds have underperformed equities by a significant percentage. Rental income is generally fairly low as a percentage of the property in question, plus many jurisdictions restrict the annual rate of rent increases to the level of inflation or below. In contrast, the Cynergy Research model portfolio, which includes 4 non-dividend paying companies, experiences an average annual dividend increase of about 7.8%, thus beating inflation by a mile. Naturally, people or companies who rent properties expect to make up for their shortfall by capital gains on the properties, but over long periods of time, properties have underperformed equities by a significant percentage. Investors can also place these funds into private funds such as mortgage funds or real estate ownership, but the fees can be generally high for this type of investment, and they are not very liquid as a general rule. Then there's the pure gambling of placing funds into seed capital or pre-IPO shares, but perhaps 1 in 10 investments survives to the IPO stage. The next investment area is public stocks, comprising small cap, medium cap, large cap, mega cap, Canadian, US, and international companies. We've gone with large and mega cap companies around the world who generally also operate globally. The next area is ETFs with thousands to choose from, hence the challenge. Which ones do you pick? Is the ETF invested in the right industry or country? Is the investment manager experienced or a relative newbie? And typically with an ETF, you get dog stocks lumped in with the winning stocks to provide breadth, and as such end up with a mediocre result in our opinion. Mutual funds pose the same dilemma, and as such we avoid them. Hedge funds are involved in a vast array of different financial strategies, plus usually come with high fees such as 2% of your capital each year, whether they make money or not, and 20% of any profits. This is a good deal for the hedge funds, but not the average investor, especially since the vast majority of hedge funds underperform the market averages per various studies. Options, such as writing covered calls, selling puts, or creating spreads, etc., are not for the faint of heart, and it's generally very easy to lose all of your capital if you don't really know what you're doing. Lastly, commodities are similar to options regarding risk, and there's dozens to choose from, plus financial products in the hundreds, including all kinds of currencies. Not for the faint of heart either, nor for the unsophisticated. The one issue regarding investing in stocks is that they tend to be volatile, which some people equate to risk, which it isn't, which sets up the topic for our next video. Thank you for watching.